Investing trouble. This is week 40, and I just want to say greetings and welcome back. Thank you.
Hey everybody, welcome to week 40. It's been a while since we recorded a video. Rio's not here today; he's upstairs doing school. So I just want to tell you what's been going on and why the big gap in between videos. So first of all, we got a little bit ahead of ourselves. We were in week 36, but it was actually week 33. So we had 3 weeks to take a little break, holidays, New Year, all that. But also we made a big change to the portfolio. We're not in individual stocks anymore. We're in index funds. One index fund actually. And the reason for that is that's the way that I normally invest. So I had a lot of people asking me how to get started and whatnot and which video they should watch. And I didn't really have a video because all the videos that we've been recording have been with individual stocks, and that's not really what I would recommend somebody to start out investing in. So we've changed this portfolio over into an index fund, and that index fund is Vanguard S&P 500 index ETF. The ticker symbol for that is VFV. So that is the index for the S&P 500, which is the 500 kind of biggest companies in America. There are some rules where they take some companies out and replace them or whatever, but for the most part, it's the 500 biggest companies in the world. So you're getting Apple, Microsoft, Tesla, all the big companies, and some of the smaller ones as well. So it's basically meant to mimic the market, which goes up about 8% per year. At that rate, it should double every 7 or 8 years, and it's very safe. It's never going to go to zero, and it's generally regarded as one of the safest investments. So with index funds, it's just one fund where you basically put your same investment amount every week, every month, however you invest, whenever you get paid. If you want to throw some of that into your investment, you don't have to do any research or anything. You just put it into the same fund every week, dollar cost average. That's what it's called. You're averaging your costs by doing that. As the market goes up and down, you are spending more or less and buying more or less. So you dollar cost average into this index fund, and that's it. You can live your life. You don't have to know anything about investing. You don't have to read financial statements, and you don't have to be up all night worrying about your investments. It's basically like a mutual fund that a bank would put you in without the fees. The difference between a mutual fund and an index fund is usually about 2%, and over time that can add up to 20 to 30% of your retirement. It does add up quick because of the compounding. So I'll show you what we've got here. This is the Vanguard S&P 500 index. You can see, we'll go to the 5-year chart of this, and you can see over the past 5 years it's 99%. So it's doubled in 5 years, which is faster than the 7 or 8 years I told you. But the market has been performing really well over the past 5 years. But you should expect to see about every 7 or 8 years doubling your money at that rate. So 8% a year is a good year. So with index investing, you always want to, if you're young, remember this is 100% equities, stocks. There are no bonds, there are no fixed incomes, and that's generally regarded as a more aggressive investment. So if you're young, that's fine. If you want a little bit more return with a little more risk, that's fine. Generally, you want to diversify that with 10 to 20% bonds, depending on your age. You can go up to 40 or 60%. There's a whole chart of all-in-one ETFs that show where you are in life and where you should be. We're going to get into that over the next few videos. Getting back to the diversifying, I like a 90-10 split. So 90% equities, 10% diversifier. Now a diversifier, it's generally over history, it's been bonds. So stocks and bonds, you've heard that term. So 80 to 90% stocks, 10 to 20% bonds. And then as you get older, more bonds, less stocks. Now, other diversified, some people use gold. Some people use, a lot of people are using crypto to diversify now. You want something that doesn't move with the overall market. So if your stocks are down, your diversifier is going to pick that up just to smooth out the volatility. So bonds do that. Crypto does not. It's not correlated with the market in any way. Gold, same thing. I like to use something completely different. I use carbon credits. It's a penalty for companies polluting. So when a company pollutes, they're emitting carbon, and they now have to offset that with carbon credits, which are gained by green initiatives, tree planting, and any business that has a carbon, they're carbon negative, which means they don't pollute as much as they are producing for the environment. Basically, they have an abundance of carbon credits, which they can then sell to companies that pollute, and those companies have to buy those in order to continue polluting. So there are ways to invest directly in carbon credits, but those are for the big fish, basically. The only way you can really get into that game through the market is with certain ETFs, and the one I've chosen here is called it's the Crane Shares ETF called Carbon. KRBN is the ticker. Now they have they trade in the global carbon market, and this does not move with the market at all. You can see the chart over the last year. It's doubled in 1 year. It's gone. It's performed really well. I don't expect to continue with that pace, but I do expect it to grow at a fairly rapid pace. So this ETF, I've owned it for quite a while in my personal portfolio. Whenever I have a red day where all my stocks are down, there's only one green, and it's always this one, Carbon. It's usually when the market's down, this one is up, and when the market is up, this one is either down a little bit or up a little bit, but it is growing pretty rapidly, and it's a great diversifier. That's what I use. So I put 10% into Carbon, 90% into the Vanguard S&P 500. Now, I spoke about the all-in-one ETFs. I'm going to look at one here for you, and then over the next few weeks, we're going to look at a bunch more. So the one that I'm going to look at for you now is called VGrow. This is one where a lot of people can't get off that. A lot of people say, you know what, buy VGrow, and that's it. That's just the one ETF that you need, and you could put all your investments into VGrow. That is basically 80% equities worldwide. So you're buying thousands of companies throughout the world, and then 20% in bonds or fixed income, which is a pretty good conservative approach. You're going to get the steady growth without the risk, and you're also going to get some income from the fixed income. So VGrow ETF, the Vanguard is currently trading at $32.42. Look at the last year here. In the last year, it has gone up 11.6%, which is in line with usual market performance. And the yield on this is 1.83. That means you're going to get a dividend of close to 2% in cash in your account. So a good mix, stocks to bonds. That's 80-20. So it's a little bit less than my 90-10, but I like it a little more aggressive. So that's why I go with 90-10. The greatest investor in history is Warren Buffett. And he was asked by LeBron James, what should I invest in now? And Warren Buffett suggested to LeBron a 90-10 index fund. That's all you need. So in Canada, there's nothing 90-10 with one fund. So what you can do is this VGrow here is 80-20. There's another Vanguard ETF called VEQT, Vanguard Equity. That's 100% equities. It's basically all the equities from VGrow without the 20% of fixed income. So if you get half and half, 50% VGrow, 50% VEQT, then you've got your 90-10 split. And you can adjust it from there. If you want a little bit more, you can go, if you want a little bit more stocks, you can go 75% VEQT and 25% VGrow, and that will take you to a 95.5. Now, if you want more bonds, then there are plenty of options. You can do 60-40, 40-60, 20-80. Those are all available with all-in-one ETFs, and we're going to get into those over the next few weeks. But that's it for this video. So Happy New Year. We're into index funds now, and hope you stick with us. It's going to be more in line with how you should be starting out. And keep in mind, I'm not a financial advisor. This is all just for your own edification. You can speak with an advisor, and you can be armed with this information and make your own decisions. Okay. Next week, next video, Rio should be back, and we'll see you then. Thanks for watching. Happy New Year. All the best.